This is recorded. This fictional party was a business meeting. And it was not socially distanced.
I will regret those remarks for the rest of my days, and I offer my profound apologies to all of you at home.
And that's why it's now the proportionate and the responsible thing to move to Plan B.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Plan B, Boris Johnson calls for Britons to work from home as Omicron spreads. Another bumper year while JP Morgan sees fees from M&A and underwriting deals surging in what could be one of the best quarterly results ever for the bank. Plus, what does the Scholz era have in store? We discuss with Florian Toncar of the Free Democrats, who's just become parliamentary state secretary in the German finance ministry. Now, let's check in on the markets to see what's going on. They opened the day higher, some 0.3% higher. I think we're still seeing some similar gains, but the picture could be quite different if we go into a Fed that disappoints the markets. We have two great pieces. First of all, our live blog, led by our Mark Cudmore, is fantastic because it goes through the nuances and the kind of disappointment that we could see on the Fed next week. Our John author is also writing a beautiful piece about the Powell pivot. The other story we're watching, of course, it's what's happening with pound because of the Plan B and, frankly, all of the allegations about that party at Downing Street and what that could mean for Boris Johnson's political career. You can see pound currently at 132.04. It could make it much more difficult for the UK and the Bank of England to hike. There was a Goldman Sachs note overnight saying that they would not be able to hike before February. The CAC 40 gaining some 0.2%. Now, to talk about all of the markets, we're joined by Freya Beamish, head of macro research at TS Lombard. We're also joined by Simon Kennedy, our executive editor for economics, in just a second. Freya, great to speak to you. Thank you so much for coming on. I know you're a China expert, and there's a lot of news on China. The markets seem to be taking this in their stride and saying no matter what happens, the Chinese authorities want to stabilize the economy. Is that the right way of looking at this?
This was always the stage of the year where that story was going to come through. Just looking at the political calendar, November, December was the point where the authorities would be able to kind of shift up a gear in terms of or overtly to shift up a gear in terms of their stimulus and their response to the very weak growth that we're seeing in the economy. But our worry is that the efficacy of that kind of China policy put has now been degraded by the shifts in the way in which monetary policy operates over the past few years. So they now target short-term interest rates rather than directly shifting interest rates for the real economy. But more fundamentally, because there isn't a marginal borrower within China that is able to respond and leverage up or would want to leverage up in this environment as a result of the stimulus that we're seeing in China. So I would say that it's okay for now to kind of play that card. But as we go through the year, the lags of about kind of 6 months from policy easing to money and credit aggregates, maybe even into the second half of next year, that's going to start to disappoint. And China really on the global scale is at the kind of the cool end of the economy. And it's a very kind of bifurcated economy, kind of leaning on this framework that we're starting to develop at TS Lombard called bifurcation inflation. And that's going to be gravitational for markets over the course of 2022.
Freya, give me a sense of, when we look at and see some of the possible defaults, and I know Fitch had something to say about Kasia and, of course, Evergrande. Do you worry that this could be systemic?
Yeah, absolutely. I worry that this could be systemic. Short answer to that. But the long answer is that the authorities at the moment are very focused on making sure that the pre-sale contracts get fulfilled. So in terms of the real economy, the full drag from construction, at least, doesn't come through again until the second half of next year. And then kind of more broadly speaking, from a financial perspective, the worry is that property assets are kind of permeated through the entirety of the economy. And it's employees, it's households, wealth management products, it's kind of direct investment. And that means that it's very difficult to contain this type of a problem. So at the moment, we see kind of fire after fire after fire being put out by the authorities. but the interval between each fire is narrowing, and therefore it becomes a more worrying situation. But the ultimate backstop, I guess, for China is that it is an excess savings economy. And that eventually we think the PBOC will be forced to step in. And it's one of those things where the worse it gets, the more likely that the upside risk comes through of the authorities being forced to properly recapitalize the banking system. But we're kind of far from that at the moment. We're very much still in the kind of putting out fires situation. And again, this puts China at in a very kind of gravitational place for the global economy, because it means renminbi depreciation essentially over a 12-month period. And that's going to exacerbate the trends that we see in goods price inflation coming towards deflation by the end of next year. And that's very important for the Fed as well.
Yeah, and Freya, this goes back to some of the things that we've heard, for example, China say on renminbi. Let's also I'm delighted to have with me Simon Kennedy, Executive Editor for Economics. Simon, I mean, this ties back to, the stabilization we saw from China, the warnings that Freya just mentioned, and what this means from the Fed. What's the chance that the Fed actually has a policy mistake? I mean, if you're a market participant next week?
Next week. So it'd be quite amazing for them to make a policy mistake next week. I think into 2022 they're going to be under tremendous pressure. You hike too quickly and inflation fades away, and that's a policy mistake. You hike too slowly and inflation stays persistent. That's a policy mistake. So I think that it's a big year for Jerome Powell and his team into 2022. We're still waiting to find out who that team will be. Some nominations still to be announced from the White House. But certainly next week, I think they're on track for a faster taper. You could say the policy mistake was made a month ago when they didn't taper as quickly as they're now talking about. So certainly think things have changed. Craig Torres from Bloomberg reporting at the weekend just what's going on inside the Fed.
Freya, give me a sense of when you look at China, what do they need from the Fed?
Well, there's almost a window of opportunity for China and the US to be kind of on the same page miraculously over the direction of the currency, because China, by all evidence, appears to be quite happy with the idea of a weaker renminbi, and they absolutely need a weaker renminbi to transition to the next chapter of growth. And if you look at it from the Fed's perspective, at this stage, of course, the administration is not on board with this over the longer term, but at this stage, the Fed needs a stronger dollar to try to tamp down on import price inflation. That is the part of the forecast that has been going wrong for the Fed, and it really kind of speaks to this very bifurcated world that we're living in. Each economy now has this bifurcation, and policy was not designed for that type of a situation. So the likelihood of policy slip-ups is now much greater, and it's very understandable why the central bankers and economists in general are getting much more squeamish about using the word transitory, and it's now completely fallen out of fashion at the Fed. But it's more than that. We now need to be more specific about what type of inflation this is and develop frameworks, as we've done, bifurcation inflation, to say what is the presence of an endemic virus in the economy? What does that mean for inflation?
Right, and actually, I guess the concern is that when you look at some of the market participants' feeling, it's really not only bifurcated. I think there's the biggest gap in like 10 years or so. Simon, I also want to bring you to the John Author's piece, which I enjoyed reading immensely, and it's basically his latest Bloomberg opinion column, the so-called Powell pivot, which markets look to have priced in, and he says the expectation is that the Fed will speed up its tapering process, with the critical assumption being that they won't have to hike rates beyond 2%. Authors warning that they price this in at their own peril. If you look at some of the market dynamics between the Fed and, for example, the Bank of England, I mean, where's the likeliest surprise going to come from, given we don't know what Omicron is at the moment?
So I think what John's talking about is where that terminal rate is, how high the Fed, when the Fed does start going, as John notes, it tends to keep going. And the argument that John's making is that in the markets, that where they think that terminal rate is much lower than some, including One analyst at Deutsche Bank yesterday suggested it should be. So perhaps at some point, if the Fed is going to go higher than the markets think, that there's going to be a kind of a readjustment in markets, which would be something of another power pivot later in the year. And that's going to increase pressure, as Craig reported at the weekend, on the Fed to kind of continue to communicate, to hold everybody's hand through this. Anna Wong at Bloomberg Economics saying next week will be that first opportunity for Jay Powell to really spread the word on what he is planning to do in 2022. But as you know, forecasting is pretty hard given the virus.
It is pretty hard at the moment. Thank you both for joining us. Simon Kennedy there and Freya Beamish from TS Lombard. We're just also getting some breaking news on UniCredit to return at least 16 billion euros via dividends and buybacks in the next 3 years. So it's not for something straight away. I don't know whether it's actually share price supportive. It is. Look at that. UniCredit gaining almost 5%. This would be dividends and buybacks between 2021 and 2024. Now, coming up, what are the top challenges facing Germany's new chancellor? We'll get the views of Florian Toncar, a member of Olaf Scholz's three-way coalition. Stay with us for that conversation. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany's new Chancellor, Olaf Scholz, has warned Russia that an invasion of Ukraine could trigger reprisals. But tellingly, in his interview with ZDF television, he stopped short of including the Nord Stream 2 gas pipeline as part of any response. Now, his comments highlight the tough position Scholz finds himself in at the start of this new era for Germany. Well, for more on this, we're joined by Bloomberg's Maria Tadeo, who has one of the advisors to the next finance minister. Maria.
Yes, and we are joined now by Florian Toncar on a very snowy day in Berlin. Of course, your state secretary at the finance ministry. Your minister, Christian Lindner, was sworn in, and you were just telling me off camera that you're very busy from day one today, and I'm sure you are. And you know, for that matter, you know, I want to ask you, during the election, your party was very clear on the red lines, but also the priorities. You said no new taxes, the debt brake needs to stay, and we're always going to call for fiscally responsive debate. I wonder, how is that going to fit in, however, in this big coalition, but also on the European level? Because you could argue in Brussels, the debate has become much more dovish.
Indeed, all these objectives were key objectives during the negotiations on the coalition agreement. And we agreed with our parties, the Social Democrats and the Greens, that no taxes will be raised, no new taxes will be introduced. And of course, the strict budget rules in Germany will be followed again post-corona from 2023 on. And we, of course, will also be committed to stable finances in Europe and to fighting inflation should it become worse during the next years. So I think it's, for my party, it's a good result. We can be satisfied, and we will, of course, go into a dialogue with the European partners on the instruments how to achieve these goals.
And you know, I want to ask you, the perception, at least in the international media, is that Mr. Lindner, you work very closely with him, is that he is going to be the German hawkish voice that comes in, and not just in Berlin, but also in Brussels, perhaps with a very different line to that of Olaf Scholz, and that could create tension. Is that something that you would say it's not entirely fair? There's a little bit of cliches that are being played in here?
Indeed.
It's a cliche
indeed.
to say he's a hog and gonna...
Absolutely. We are a clear pro-European party. Our coalition agreement also is committed to to increase, to enhance, to improve European sovereignty. And of course, we need to learn in Europe to do things better in own responsibility. And we want to contribute to that as Free Democrats, but also as a German government as a whole. But still, we are convinced that fiscal or monetary stimulus cannot permanently replace economic substance and competitiveness. And we must find ways, I'm very, very convinced, to work on our competitiveness if Europe should play a strong role in the world's economy and politics in the future.
But your message, I guess, to other European partners is that there's nothing to fear. That this is it's fine, and we can all relax.
No, if there are things we need to discuss, we need to discuss them and find sound compromises which bring Europe forward. And this is what we will try to do at our best. But we have own convictions, of course, what is better and what is worse. which we will bring into these European discussions.
And you're going to push for, of course. And I wonder, you mentioned inflation. This is a huge debate in Germany, politically, economically, at times also societal. How worried are you about the numbers that we're seeing? And the big question is this one-off or is this actually something sticky? It does seem that you worry that this is not just a temporary effect.
First of all, I think it is recognized throughout Europe that we need to discuss the inflation issue. Even within ECB leadership, I think the discussion has changed to some regard, and there is more attention to the issue. We cannot fully be sure whether it is temporary or it is permanent. Probably in the direct aftermath of the pandemic, inflation will tend to normalize maybe between 2 and 3%, but there are also permanent inflation drivers such as shortfalls in supply chains, such as in Germany a lack of skilled workforce we can use. So the wages will probably increase, at least in parts of Europe, in Germany certainly. And the transition of the economy, the decarbonization process will cost money, which will be reimbursed in the end to the consumers. So I see, maybe not on the short term, but on the long run, permanent inflation risks we should anticipate.
And I would love if you could give me a name, but I know it's your first day, so I don't want to get you in trouble. But the Bundesbank, of course, you have in many ways praised the work of Mr. Weidmann. Is that the type of profile that you want to see take over the central bank? Someone that's at times very open, very going against the consensus in the board?
Well, this is a question of how someone acts or behaves. But certainly the tradition of Bundesbank to look onto stable finances, onto economic substance rather than some sort of modern monetary theory and other things is certainly the right way. And I'm sure we will provide a good proposal for the Bundesbank presidency. But no
a woman or man?
No disruption with the tradition of the Bundesbank, but rather a sound and modern continuation of.
But surely you must have a name in mind that you lean towards.
But it's up for the Chancellor and the Finance Minister to tell the public who it will be. But it will be, I think, a very reputed, a very high-profile person.
And just a very brief question on Commerzbank. There's many questions about what's going to happen with the state stake that you have in the institution. Do you want to sell it? When do you want to do it? And are you open perhaps for, what is an international sale? It doesn't have to be to another German institution.
Well, we will fairly assess the status of Commerzbank and the progress they made on their reforms, their changes, and then we will assess options. But we will not discuss that on the public market, but rather tell the decisions we have made as soon as they have been made.
Florian Toncar, thank you so much for joining us, and good luck on your first day. We'll see you very sure. I'm soon for that. Well, thanks for that. Francine?
Maria, thank you so much. And also thank you to the German Deputy Finance Minister. Great job. We'll have plenty more, of course, on Germany. We'll also have plenty more on the UK. Boris Johnson tightening restrictions in England to halt the spread of Omicron as he faces pushback over allegations his staff broke lockdown rules last year. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to Freya Beamish from TS Lombard, who's still with us. Freya, when you look at, we were talking about China and some of the concerns that you had, and you beautifully laid out what you expect some of the policymakers to do. But what does this all mean for supply chain issues, given we have Omicron and we don't know exactly where this ends?
So what we're trying to do now is develop a framework for inflation and growth that is specifically designed for an economy facing an endemic virus. And what we've done for that, we're terming it bifurcation inflation or biflation. And what we're doing for that is to really look at how the supply side is adapting, both in terms of what capex is being done, what hiring is being done, and the kind of the glitching of the supply chain. And what we notice is that in response to these kind of simultaneous positive and negative demand shocks, the positive side has obviously had greater inflation and therefore has had greater profits. And therefore, that's where we see the supply side adapting. So when you get high COVID periods, it's much less likely that we get the same extent of positive earnings boost and positive inflation spikes as well. But on the other side, if there's low COVID periods, then there's actually been atrophy of the supply side there. So it's kind of an asymmetric diminishing of the inflation impact of COVID and Omicron on the economy.
Freya, we only have a minute left, but what's your take on the German economy right now and the biggest challenge for the new government?
The biggest challenge for the new government is to kind of move forward with the fiscal changes. My colleague on the European side, Davide Aneglia, says that it's the breeze of fiscal change rather than the wind of fiscal change. So we see all that going in the right direction, but it's still a challenge. And in terms of inflation, the biggest threat has been on the goods price side. And that should come off really quickly over the course of 2022. We actually see Chinese PPI in deflation by the end of next year, and that should feed through to easing off of inflation globally and giving central bankers a little bit more space.
Freya, thank you so much. As always, Freya Beamish, their head of macro research at TS Lombard. Coming up, there's new data on the infectiousness of Omicron, and we'll go through it shortly. This is Bloomberg. Here are your top stories. Plan B, Boris Johnson calls for Britons to work from home as Omicron spreads. Another bumper quarter, JP Morgan sees fees from M&A and underwriting deals surging in what could be one of the best quarterly results ever for the bank. Plus, the Scholz era, Germany's deputy finance minister tells his program that Berlin will adhere to strict budget rules after the pandemic. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's check in on the markets. We're seeing a nice little lift to the markets today. We actually started the day about 0.3% higher. Now, we're seeing pretty much the same kind of gains, although we're seeing a little bit of a reversal, for example, for the CAC 40, I think. Now, if you look at some of the European stocks that are actually climbing, traders are really betting that the global recovery will be resilient to the new virus strain that is spreading around the world. I have telecommunication shares leading the increase amongst the Euro Stoxx 600. And then if you look at some of the things that were also supportive of equities is, for example, in Hong Kong and China, we're up where policymakers are seeking to shore up the economy. All right, UniCredit, look at that, a jump, getting some 6.7%. The company said they intend to return at least 16 billion euros to shareholders by 2024. That means they're effectively doubling rewards as part of a new strategic plan focused on organic growth. I think one of the biggest gainers by far in today's trading session. Now, the Omicron coronavirus variant is more than 4 times more transmissible than the Delta variant in early stages. That's according to a Japanese study that looked at data from South Africa. Pfizer says the company will have more data on its vaccine's ability to repel Omicron by the end of the year. Well, speaking to Bloomberg, the Pfizer chief executive, Albert Bourla, said he's optimistic about the ability of the vaccine to boost protection.
What I think the data are telling us, it is that basically 3 doses of the Pfizer-BioNTech vaccine will provide for Omicron the same protection like the first 2 doses provided for the initial strain.
Well, joining us now is Bloomberg senior pharmaceutical analyst for Bloomberg Intelligence, Sam Fazeli. Sam, it seems that the market, good morning again, but the market is no longer worrying about Omicron to, what it could be. Are they wrong about this, or did we get more positive news?
Francine, thanks for having me back. I think what we need is to wait for more and more data. I would say that all the time. I'm an old scientist and I can't get out of that habit. These are all very early data. There is another study that was published that showed a much worse activity after a booster shot for the Pfizer-BioNTech vaccine against the Omicron variant. So why are these 2 data sets so different? This is why I think we need more and more information to hone down what this actual booster shot's doing, at least in terms of antibodies. Again, let's not forget, there's another arm of the immune system that should help us protect against severe disease, which is what hopefully we'll find.
So, Sam, how good was the data from Pfizer?
So what I was really interested in is the other nuances that came out rather than the neutralization data itself, which they showed that after a third shot, you had a good level. Because as I said, there is a conflicting data out there. But it was interesting to see how many of the areas that the T cells, the cellular arm of the immune system uses, were still preserved in the Omicron variant. And also that actually when they used blood from somebody who was boosted with a vaccine representing the Alpha variant, they had much better result. So time will tell, but we need a lot more information here before we get really a good feel for how well vaccinated people with the third shot are protected against an infection.
Sam, is it possible to have a vaccine that actually, protects you from all coronavirus, or is that science fiction?
No, it's possible. Even mRNA vaccines were science fiction 2 years ago. The point is, it's a lot harder, and we need to do a lot of work to get to that point. I wouldn't be surprised if you're already going to have some protection against severe disease caused by some of the current coronaviruses, and certainly some of the older coronaviruses, which were the SARS variety. So time will tell, but I think we will already be seeing some benefits in people who've been vaccinated against those coronaviruses.
All right, Sam, thank you so much, as always, for the update. Sam Fazeli there, Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Coming up, we'll be speaking with Adi Pinkster, the Chief Executive of Adelpha, which advises companies, many of them led by women, on scaling up. Stay with us for that fascinating conversation up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition, and I'm Francine Lacqua here in London. Now, the Prime Minister Boris Johnson has announced new curbs in England to stop the spread of the Omicron variant. He gave a press conference yesterday on the measures.
It's become increasingly clear that Omicron is growing much faster than the previous Delta variant, and that's why it's now the proportionate and the responsible thing to move to Plan B.
Well, Plan B involves advising people to work from home and mandating the use of so-called vaccine passports in large venues. Let's get into what all of this means. Joining us now is Rosalind Matheson, our executive editor for international government. I have to say, Ros, a lot of people accusing the government of using this as a side tactic so that they don't think too much about the fiasco that was this potential party in Downing Street when we were in full lockdown. Can Boris Johnson keep his job at this point?
Well, certainly he faced this question head on last night when he was announcing the new restrictions. Is the timing of this designed purely to deflect from the furor over whether there were multiple Christmas parties last year in Downing Street and contravening, of course, the strict lockdown rules that were going on then? He, of course, says, and his scientists say the same, that Omicron is replicating itself at a speed where they really need to act now to prevent a significant rise in hospital cases, particularly of the virus, and he vehemently kind of denies that is the motivation behind the restrictions. But of course, he's under significant pressure, not just from the public or the opposition, but his own party over his handling of these events over the past 18 months. And certainly whether there was one rule for certain people in his party and one rule for the member of the public, because his senior Tory lawmakers are sort of a bit sick of having to come in behind him and clear up these messes. Of course, he's famed for having a Teflon-esque quality to him, but his popularity is really under some significant pressure here.
Yeah, and Rose, he's had a pretty tough, day yesterday and probably week. There was that pretty humiliating, actually, appearance in the House of Commons, and then this morning he woke up to, newspapers and tabloids in the UK that just lambasted him. There doesn't seem to be one newspaper or tabloid that's actually behind the Prime Minister so far. What do we know about, the more conservative faction of his Conservative Party? Are they still behind him?
Well, you can see that even the press in England that tends to be fairly favourable to the Tory party is starting to dip their toes in to criticism there very gently, which does tell us that perhaps there's a lot of angst coming from senior Tories who are talking to those media outlets and conveying their sense of frustration. Meanwhile, the UK economy, of course, is lagging other countries in recovering from the pandemic. There are big questions still over Brexit and where that's going to go. He's picking fights still with the French over that. There's a lot on his plate and a lot of things that really need to be addressed in order for the Tories to get re-elected when that comes around in a couple of years, particularly his levelling up agenda in parts of Northern England that used to be Labour strongholds. So they want him refocusing on that and away from these kinds of distractions and self-inflicted disasters. So certainly if his polling continues to be rough over the next 6 to 12 months, you're going to see real conversations about whether he is the best person to lead them into that next election.
Ros, thank you so much. Rosalind Matheson, their executive editor for international governments. Now let's get straight to your Bloomberg Business Flash. Here's Max Ramsey. Hi, Max.
Morning, Francine. Evergrande, the Chinese developer whose liquidity crisis has shaken the nation's credit markets, has defaulted for the first time on its dollar debt. The property giant's long-term foreign currency issuer default rating has been cut to restricted default by Fitch Ratings. Earlier, Hong Kong's financial regulator told us stress tests in the wake of the debt crisis don't show elevated systemic risks for the city's financial system.
It's a significant event. I mean, you can't possibly underplay it, but it's not that category of event for the financial system.
You believe it's ring-fenced?
Yes.
Apple is on the verge of reaching a $3 trillion market value, less than 4 years after surpassing the $1 trillion mark. Shares rallied to another record high, taking its valuation beyond the market cap of Germany's entire stock market. That's as the company won a delay to court-mandated changes to its App Store, marking a victory in its ongoing legal battle with Fortnite maker Epic Games. And that's your Bloomberg Business Flash, Francine.
Max, thank you so much. Now, of the thousands of hedge funds, only about 80 are led by women. That's according to the Kresge Foundation, a U.S.-based philanthropy that tracks diversity amongst managers. So where does a woman business leader go to get help finding investors? Well, Addie Pinkster is the founder and chief executive of Adelpha, which helps mostly women-led companies find backers. Now, Adelpha focuses more on scale-up companies that have already been around for a few years and which need investment to grow rather than startups. Addie has just won the NatWest Every Woman Fortuna Award given to individuals who invest in or secure investment for women-founded business, and she joins me now. Addie, thank you so much for joining us. Congratulations on the award. Are we still in 2021 and talking about this because there's a structural problem, or really the pandemic has also set women entrepreneurs back?
Thanks for having me, Francine. I think it's both. Fun enough, we had a board meeting yesterday at the Treasury looking at investment into female entrepreneurs, and what we found was that we know there's a structural gap and that is improving, but sadly that has taken a dip during COVID, which I think is possibly relates to what's quite well known now about women having to take more of the caring responsibilities during the COVID pandemic. But there is a gap.
But is the problem that actually not enough women want to be entrepreneurs, or the problem is actually they don't get funding because when a bank looks at their portfolio or some of the VCs, they want to replicate themselves, they're mostly men, and so this cycle just perpetuates itself?
I think it's a whole ecosystem we're looking at. So a bit of it is about inspiring women to do it and saying you can. I think there is, and frankly, not everyone wants to grow their company and wants to raise money, and they shouldn't have to. So I think the peer pressure, a bit like the lean-in movement, can be a bit too much at times. But the point is, when they do want to grow, are the two sides communicating on the same language? Do they know each other? Is there a network gap? One of the really interesting things about funding for growth companies is that when you look at systematic funding platforms, for example, R&D tax credits, EIS allocations, government loans, anything that involves a systematic application, women score much, much better on funding. It's much more in relation to direct equity investments, which is a little bit more word of mouth, a little bit more subjective and judgmental, that they're underscoring.
So are you putting the two and two together, like investors with female entrepreneurs, or do you actually have a lot of cash waiting to be deployed?
Yeah, we don't run capital ourselves. We work with a lot of investors who are ranging from high net worth individuals, family offices, VCs, and institutional investors. We sit in the middle. We scan for unstoppable trends, really high performing companies within them, and when we do, we make sure the market knows about it. And that is actually, we don't go out to try to back women. We are looking for the best performing tech and growth companies within the UK. We've done about $500 million worth of transactions in the last 5 years. But of the 35 companies we've done within that, 68% are female-led. Okay. But diversity goes so much further. Like, that's the kind of
So, Addy, what are you asking for the government today? First of all, how does the UK rank in terms of, investing in female entrepreneurs compared to other parts of the world? And the government in a spot of trouble today, I mean, can they do anything to help, female entrepreneurs?
They can and they are. So Alison Rose from NatWest Group is leading a phenomenal board. We were with Minister Scully yesterday talking about exactly this. Considerations, for example, again, it's ecosystem-led. So it's how can we get LPs who are investing in funds to make sure that the funds are putting proper discipline and addressing unconscious bias. One of the big questions we're talking about at the moment is support for care at home, family care, childcare. And we're looking at other nations to see examples where that works particularly well.
And have you found a nation where it works particularly well? I mean, the U.S., is often, you kind of look at the U.S. and say maybe there's a little bit more social mobility than maybe in some of the European countries.
The US, the amount of VC funding that goes into female entrepreneurs in the US and UK is about on par. It's sort of 3 or 4%. Scandinavia performs a lot better. We were looking yesterday at German tax breaks with regards to family care, but I really actually think this is a private sector item. I think my view is that institutional investors are looking for high conviction, uncrowded trades, and public market investors really understand the importance of unconscious bias in addressing investment decisions. The world is moving that way in private markets. We're just helping push it a bit further.
And is there a part of the market, and actually I had this conversation also on private equity with a big private equity investor. If you look at the financial space, so brokerage, mortgages, VC, everything else, including insurance and private equity, where is there a lack of women representation most felt?
In terms of the people who are working with the organisation, or where the capital gets deployed?
Both.
I'm going to invert it a little bit and tell you where it's really good. Okay. So one of the points I'd mostly make is that LP investors, the people who are investing into funds, are very diverse. Mm-hmm. So if you look at your report last week about female-led hedge funds, what's interesting is women are fairly underrepresented within the hedge fund industry from ground roots up. But the people who are investing are quite diverse and are absolutely looking for diversity. And frankly, hedge funds are looking for diverse fund managers as well. The area that we think is absolutely on fire and does the best job is family offices and private investors. And it's not just about backing women, it's all sorts of minority founders, but more importantly, it's where the end impact is.
Okay, brilliant. So by that, you can also say the ones that should be doing better, and I hope you're all listening. Andy Pinkster, their Chief Executive Officer of Adelpha. Coming up, JP Morgan set for another bumper quarter. The Wall Street giant sees investment banking fees up 35%. That's coming up next, and this is Bloomberg.
Anybody have any questions today?
Do you recognise those reports?
I went home. Hold on.
Would the Prime Minister condone having a Christmas?
What's the answer?
I don't know. It wasn't a party, it was cheese and wine.
Just be clear, it's not.
Is cheese and wine all right?
No.
It was a business meeting.
I'm joking.
This is recorded. This fictional party was a business meeting. And it was not socially distanced.
My remarks seemed to make light of the rules that people were doing everything to obey. That was never my intention. I will regret those remarks for the rest of my days, and I offer my profound apologies to all of you at home.
Well, that was Allegra Stratton, former spokesperson for the Prime Minister in COP26, resigning after video emerged of her joking about an alleged Christmas party last year. Now, let's switch gears to banking. JP Morgan's fees for M&A and underwriting deals could rise about 35% in the fourth quarter, one of the best quarterly results ever for the bank. But like Citi, JP Morgan expects results to be flat in equities trading and down in fixed income. Well, joining us now is Bloomberg opinion finance columnist Paul Davies. Paul, great to have you on the program. So first of all, is this a trend that we're seeing widely across the industry?
Yeah, so it's obviously been an extremely busy year for M&A. I think we're closing in on probably a record year, well, definitely a record year. We've already seen about $3.5 trillion worth of deals, and that already exceeds the record that we had in 2007, in M&A, that is. And obviously it's been a very big year in IPOs and debt issuance as well. In IPOs and debt issuance, things are slowing down, I think, in the fourth quarter, as expected compared to last year, certainly. And actually in M&A as well, the volume of deals we've seen in the fourth quarter is less than the same period last year. So JP Morgan is maybe a bit of an outlier.
I was going to say, they've absolutely killed it. So it's
Yeah.
difficult to kind of look at JP Morgan and say, look, they've just smashed it through, in terms of what people were expecting. They'll do so again, and it will permeate in the industry.
Yeah, that's right. So, I mean, we've yet to see, I think, some strong indications from any of the other big players about what they think they've done in the fourth quarter. It'll be interesting to see what Goldman and I guess Morgan Stanley do on M&A as well. But yeah, I've not heard any of those numbers yet.
What does it mean for bonuses?
Bonuses is going to be a really interesting topic this year for a couple of reasons. One, there's obviously this big war for talent going on. Lots of executives have already been talking about how they're going to have to pay people a bit more because they're trying to keep people in their jobs, because lots of people have been moving. And another reason is last year they kind of held back on pay a bit. I was looking the other day at the comp to revenue ratio that we always look at with investment banks. And it was lower last year than it had been on average for the previous 10 years. They obviously kind of held back a bit. They weren't really sure how things were going. It was a difficult year for most of the year last year. So this year is going to be, much bigger numbers, I should think.
Paul, a story that's actually really well read on the Bloomberg terminal is the fact that the Credit Suisse chairman broke the quarantine rules.
Yeah.
I mean, this is something else, bad attention for Credit Suisse when they, again, don't need this bad attention over and over. Does it actually translate into anything?
Well, I don't know yet, actually, to be honest. I mean, it's an odd story. It's an interesting story. He seems to have, left quarantine in Switzerland after being told that he shouldn't, and quite quickly. He was supposed to be there, I think, for 10 days, and he's left after 3. It's an unusual situation. I don't know exactly what's going to happen, but it's certainly embarrassing.
Yeah, and certainly we'll keep on top of it. Paul, thank you so much for joining us. Our Bloomberg Opinion Finance columnist, Paul Davies. Now, let's get straight to the Bloomberg First Word News. Here's Max Ramsey. Hi, Max.
Morning, Francine. South Africa's excess deaths almost doubled in the week ending November 28th from the preceding 7-day period as a new coronavirus variant spread across the country. The rise, while only reflecting a week of data, contrasts with hospitalization numbers that show that most admissions have mild forms of COVID. Meanwhile, a Japanese study of data from South Africa has found the Omicron variant is 4 times more transmissible in its early stage than Delta. UK employers increased starting salaries at a record pace in November. That's according to a survey by the Recruitment and Employment Confederation and KPMG. They say firms are being forced to boost compensation to tackle an unsustainable shortage of workers. Starting salary inflation is at its highest since data collection began in 1997. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Max Ramsey. This is Bloomberg. Francine.
Max, thanks so much. And also a reminder, China Evergrande officially being labeled a defaulter for the first time. This is the latest milestone, of course, in this months-long financial drama that paves the way for a possible massive restructuring of the world's most indebted developer. We'll have plenty more on that throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
Watching these different markets move has been a little bit confusing.
The markets have levitated in this sea of liquidity.
Investors are fearing the Fed and the opportunity for the Fed to make a misstep here.
I think there is a prospect for a bit of a surprise, a bit of discomfort by market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, December 9th. Our top stories today: a fourth quarter preview from Wall Street. JP Morgan expects investment banking fees to soar 35%, but trading results there and at Citi are likely to be flat at best. Back to the future. Jefferies is telling employees that once again, they will need to work from home because of a rise in COVID cases. We'll see whether the rest of Wall Street follows the firm's lead. And a new study confirms fears about the Omicron variant. It's found to be 4 times more transmissible than Delta. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller in Berlin and Kailey Leinz in New York. Anna Edwards is off today. And Kailey, that frenzied pace of the Buy Everything rally seems to have run out of steam, at least for today.
Yeah, and at least in the U.S. and maybe to a smaller extent in Europe. But that buy the dip mentality, or at least the rally, still continued in the Asian session. The MSCI Asia Pacific Index was higher for a third day in a row, and the outperformer within that was China. There's a number of stories to point out within China overnight. On the one hand, we got inflation data showed it decelerated in the month of November for both consumer and producer prices. So that actually is encouraging in that it may indicate the PBOC has a little bit more room to ease if it can focus on growth and not inflation. And speaking of the PBOC, it also set a lower than expected reference rate for the yuan, maybe getting a little bit uncomfortable as that currency sits at its strongest against the dollar since about 2018. After that, we did see the yuan giving back some strength, though the U.S. dollar stronger by a little less than 0.1%. Right now, it's sitting just around 6.34. But of course, the other story we're watching out of China is that Evergrande, that heavily indebted property developer, has officially been declared in default for the first time after it missed a dollar bond interest payment over 30 days ago, and that grace period expired earlier this week. And that has shown up in Evergrande's dollar-denominated debt, which is now trading around 20 cents on the dollar. Now, here in the U.S., as I mentioned, the rally doesn't look like it continues this morning, losing a bit of steam after 2 days of gains here stateside. Right now, S&P 500 futures are in negative territory by about 0.2%. Also, just keep an eye on volatility because, of course, we went out way to a 30 handle last week. We've come in, actually closed sub 20 yesterday, ticking up just a touch this morning at 20.3 on the VIX at the moment. We are seeing a little bit of a bid coming into treasuries, down 2 basis points on the 10-year yield. 150 on the dot is where we sit. And then just pointing out crude is on pace for its best week since August, but giving back a little bit today after 3 days of sizable gains, down about 1/3%, trading at 72.13, Matt.
That's interesting. New York crude is down. I saw Brent actually rising a little bit today. Maybe it's turned around in the last few minutes, but I just checked. Take a look what's going on here in Europe. We have some green on the screen, so there are still some gains, but they're not pronounced. And in fact, the DAX is actually down a little bit right now. The FTSE is actually down. They're only small drops, which is why these countries are gray. They have to move more than 0.1% before we turn them red or green. In terms of the FTSE, I'm watching it very closely after yesterday's announcement from Boris Johnson about Plan B, about returning to work, about using vaccine passports. And let's put the FTSE up right here. We can go ahead and take a look at the index. There you go, 73.29, so off about 0.1%. I wanted to put UniCredit up here. The Italian bank is going to spend $16 billion in buybacks and dividends over the next 3 years, I think 21 to 24. So that's a big deal, and investors are buying the stock. It's the biggest gainer on the stock 600. The euro I'm watching very closely as I prepare to move back to New York. It would be fair to say I'm pushing for some strength, but right now we see it down a little bit at 113.20, and Bitcoin also down a little bit, about 3%, and this has really been a risk indicator, Danny. So it's interesting to see Bitcoin fall even as futures are up.
It really is fascinating, especially given that this past weekend we saw Bitcoin get absolutely destroyed. The willingness to step in and buy the dip there seems like it's dissipating as we get to the close of this year. Now, we're focusing on Bitcoin, but let's go ahead and look at what else is ahead today. First up at 11 a.m. New York time, the Federal Reserve Bank of Minneapolis hosts a summit. Speakers there are going to include Bank President Neil Kashkari, but what we might hear from might be limited considering the Fed is in a blackout period until their decision next week. Now, also, Joe Biden is going to host the virtual Summit for Democracy. The president will deliver the summit's opening remarks and participate in the leaders' plenary. And we're also going to get some U.S. data. That's going to include the almighty weekly jobless claims, Kailey.
And of course, it's all teeing us up for the CPI print tomorrow. But of course, overnight, we learned that J.P. Morgan's fees from M&A and underwriting deals could rise about 35% in the fourth quarter, one of the best quarterly results ever for the bank. But it also expects results to be flat in equities trading and down in fixed income, as does its peer Citigroup. Let's get more on this with Sonali Bosick, our Bloomberg Wall Street reporter. So, Sonali, we knew the trading boom couldn't last forever. Maybe the investment banking boom can.
Yeah, there are some forces that'll definitely keep the boom running, and that includes a lot of dry powder. Remember, Blackstone, Carlyle, Apollo, all in the market for another set of flagship funds. SPACs still have a lot of dry powder on the sidelines, but some of this volatility begs to question at what point do some of the underwriting activity activities also start to moderate. We've still seen a lot of strength and a lot of businesses still up from 2019 levels even, Kailey. And as we know, right now, we're making a lot of comparisons to what it was like before the pandemic.
So for me, Shanali, the story of the day, the overriding theme is this the end of return to work? Because not only have we got Plan B in the UK, we're back in lockdown for the unvaccinated here in Germany, but now on Wall Street as well, Dick Handler saying that Jefferies is going to ask its employees to work from home at least through the end of the month, right?
Yeah, this is really the first firm we saw do a move like this. There is some caution that's baking into the market here, Matt, because when I speak to executives, you see a lot of events starting to be canceled in New York. They're worried about getting people together outside of work, compromising people who can still come to work. So why be together when you don't necessarily need to be together? Over at Jefferies, they made the point that, you know, in a single day with 10 people testing positive for COVID, it means another 50 people have to be quarantined, which is obviously very disruptive to a workforce. But we don't see a full scale of banks asking people to work from home at this time, especially in such a busy quarter. A lot of people are not even taking vacations into year end.
Yeah, the work Christmas party season not looking so bright this year yet again. Shanali, thanks so much. That's Shanali Basak, our Wall Street reporter. Now, relatedly, many companies are changing their return to work dates yet again in response to the Omicron variant of COVID-19. But few of them have gone as far as Lyft, which won't require staff to return to the office until 2023 at the earliest. Meanwhile, UK Prime Minister Boris Johnson has announced new restrictions and has advised people to work from home.
It's become increasingly clear that Omicron is growing much faster than the previous Delta variant, and that's why it's now the proportionate and the responsible thing to move to Plan B.
Johnson's so-called Plan B represents a significant change in approach and is politically risky for the UK Prime Minister. His gamble comes as a study from Japan shows the Omicron variant is 4.2 times more transmissible in its early stage than Delta. For more, let's get to Sam Fazeli, Bloomberg Intelligence's senior pharmaceutical analyst. Sam, given what we know about Omicron so far, is it necessary that we return to that environment where we're all working from home?
Yeah, hi, good morning. Frankly, whether the data from Japan is exactly right or not, but the anecdotal information that we have with the pace with which this variant is spreading suggests that it's highly infectious. And part of that's likely to be the fact that it completely ignores the fact whether you were vaccinated or previously had an infection and can still infect you. So there's only one solution to stopping that, and that's by keeping people apart a bit more than you were doing before. Work from home is one way of doing that.
Sam, it seems that the science here isn't answering really our questions about the efficacy of vaccines. Yesterday, I saw a line saying that the loss of immune protection is robust, but not complete. That's not really telling me a heck of a lot. And today, the WHO is saying there's no conclusive evidence that vaccines are not effective with Omicron. Well, you could say that about literally anything.
Yeah, Matt, people have to choose their phrases really carefully. If you're talking about the risk of severe disease and hospitalization, it is very likely, given what the data suggests, and remember, these are all lab data, they're not people data, that being vaccinated and even possibly previously infected, you do have a reasonable protection against severe disease rather than a cold or symptoms at home. But if we're talking about cases and people just catching the infection, I think the data is suggesting that that's likely going to be pretty low when it comes to Omicron.
All right, Sam Fazeli, Bloomberg Intelligence's senior pharmaceuticals analyst, thank you so much. The WHO also seeing that a lack of vaccinations in Africa is giving the virus an easy path. And speaking of vaccinations, over in Washington, the U.S. Senate has sent a message to President Biden on his vaccine mandates. It voted to block mandatory shots or testing for the private sector in mostly symbolic defeat for the administration. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. So, Jack, symbolic moves are often the name of the game. Does this actually mean anything for the administration's policy here?
In this case, symbolic is the right word to use. The Senate voted and got 2 Democrats to side with the 50 Republicans in a 52-48 vote through the Congressional Review Act, which allows Congress to step in and try to block regulations by an administration. But it's still a bill that has to become law, which means you have to look to the House and the president himself for his signature. There's been no indication that there's any interest from House Democrats in taking this up. And again, there's only 2 Senate Democrats who voted for it. And yes, it would be subject to a veto by the president. So this is really a symbolic rebuke by the Senate, a narrow Senate majority. And it seems that the court system is where opponents of these mandates are focusing their attention. And yes, we recently saw the suspension of one of the mandates on government contractors. So there's some good news for opponents of this. But the Senate action and really any legislative action against this is probably just not going to be effective because the president has a veto.
Well, it's a busy day for the president, Jack. He's also hosting a summit for democracy. It's going to have over 100 countries represented, something that a Chinese official had called a joke. What is the administration's hoped outcome of this event?
So it is a big day for foreign policy actions generally by the president. This is the Summit for Democracy. It involves about 100 different countries. I'm not sure there's a particular agreement that they're hoping to come out of it, but you've heard so much from the Biden administration about trying to stand with traditional allies and support democracy. And the inclusion of Taiwan in this particular event is what drew a rebuke from China. And then, of course, later in the day, he has a call more focused on Russia with Ukrainian President Volodymyr Zelensky, and then a call with Eastern NATO allies. So it's a pretty big day in terms of the China and Russia watch for the president today.
All right, the geopolitical agenda and the domestic agenda. Thank you so much for running us through all of it, Jack Fitzpatrick of Bloomberg Government. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I know Danny is going to make fun of me for doing this because she always says I'm gloomy when I talk about 3 downside movers, but I'm going to do that this morning. One of them is Lucid Group, of course, the EV maker. It announced a $1.75 billion convertible bond offering after the bell yesterday. As a result, those shares down about 5.2% in pre-market trading. Another downside mover is GameStop. We actually got some fundamental news out of the meme stock extraordinaire, and it wasn't really all that great. It reported a wider loss than expected, and there wasn't really any strategy outlined on the call. So as a result, that stock is down about 4.2% pre-market this morning. It's still up more than 800% on the year, though. And one big downside mover as well is Rent the Runway. Of course, this is the subscription fashion company where you can rent designer clothes. It also reported a loss in its first earnings as a public company, and that stock is down about 11% before the bell, trading at $10.24 after it IPO'd at $21 a share back in October, Danny.
Kailey, those are some good stories. I'm going to cut you some slack for today. Just for today. Next time, I expect some green on the board there. All right, well, coming up, we're going to weigh, speaking of which, some of the market risks as we look at this lackluster equity trading session. We're going to speak with Luca Paolini, Pictet Asset Management Chief Strategist. And Boris Johnson on the back foot, how the Prime Minister's COVID plans might impact the UK economy. Plus, the future is fusion. We'll take a look and some of the stock of the clean energy tech that's being backed by billionaires. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kailey Leinz in New York and Danny Berger in London. I'm looking at the 2s, 10s Treasury curve right now. It is near the flattest level that we've seen it in a year. I believe the spread is just about 78 basis points. But Venram is predicting it's going to shrink even more by 24, 25, 26 basis points into 2022. He's our currency strategist at Bloomberg MLive, and he joins us now to tell us why. Ven?
Morning, Matt. That's absolutely right. We are looking at 24 basis points of narrowing of the 2s, 10s curve next year. Why do we expect that? We expect that because the Fed is going to go raise rates by at least 50 basis points next year. Now, historically, if you look at the previous 3 Fed cycles where they've raised rates, that 24-point projection is consistent with what has happened in the previous 3 Fed hiking cycles. So I do think that, as we go into 2022, 23, 24, with further and further hikes, I think that the curve is going to flatten a lot more. Now, that says a lot about what's going to happen to the front end. The front end is going to explode on the face of its holders because, the front end yields are going to climb and climb. Long end, unfortunately, is not going to rise so much because of the Fed's balance sheet. The Fed is supporting the long end of the market with sitting on so much of treasuries. So until we talk about a balance sheet runoff, the 10-year and the 30-year segment are going to sit smug. So we are in for a long time of flattening of the curve.
Mm-hmm. Okay, so Ben, that's looking out over the more medium term. In the more immediate term, we have CPI tomorrow. We have the Fed decision next week. If we get, as expected, hot inflation and the Fed announcing an accelerated pace of tapering, are those going to be catalysts, or is that already baked in?
I think that's pretty much already baked in because if you look at, we are going to get the highest inflation print in so many years or decades tomorrow. That is already expected and priced in by the market. But if you look at the five-year inflation swaps, we are pretty much around 250. So that is consistent with the Fed's average inflation targeting framework. So the markets are not saying, we see runaway inflation past 3% or something like that 5 years down the line. They're saying 250, and they've been saying that for a long time now. So I don't think that the print tomorrow is going to change the paradigm for the markets.
Ben, it is remarkable to look at a Fed where expectations are more hawkish and contrast that with the BOE, which after these new restrictions, expectations are for them to go on hold. How bearish is this for sterling?
It's pretty bearish for sterling because, as you said, Danny, we have just gone from just before the November meeting, we were fully priced for a hike, and now we are 40% priced for a hike this month. And I don't think there's one coming this month because of the Omicron variant that you mentioned. And that means that, sterling is going to feel the pinch. And I do see that sterling will probably test 130 against the dollar in the short term. But as the BOE starts raising rates next year, hopefully, then sterling may get supported.
All right, beating the drum to some big central bank decisions next week. Thank you so much to Ben Rom of Bloomberg M Live. And of course, for more market analysis, you can check out MLIV Go on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, alongside Matt Miller in Berlin and Kailey Leinz in New York. Anna Edwards is off today. Matt, there's really only one thing that anyone is talking about in the UK right now, and that's the pressure that Boris Johnson finds himself under. Yesterday, he gave a press conference saying that there are new restrictions put on. The only thing that the media asked him about on the press conference was this alleged Christmas party. Trust is at an all-time low, and here we're looking at a live pictures of Parliament.
Do you remember when Dominic Cummings got busted for driving with his entire family out to Barnard Castle, ostensibly to test his eyesight? My favorite Brew Dog, put out a special edition. It was a hazy double IPA called the Barnard Castle Eye Test. So my new suggestion is that they put out a Boris Johnson Christmas Party ale.
Oh, interesting. I do like that. Hopefully unrelated to driving, though. I hope you're getting royalties on that, Matt.
You shouldn't be driving when you're drinking, when you're enjoying an adult beverage, but you also shouldn't test your eyesight with your kid in the car.
Yes. That is true. That is true. Well, it feels like one scandal after another. Kailey, can you take us away from the scandals? What's going on in the market right now?
Yeah,
please.
Let's get back to the markets. And we are losing a little bit of steam after 2 days of pretty sizable rallies, at least for U.S. equities. Right now, the Stock 600 is off of its highs. It's down just fractionally now at this point, down less than 0.1%, but still giving back some earlier gains. And here in the U.S., when it comes to S&P 500 futures, we're off by about 1/3%. You are seeing a little bit of a bid coming into the bond market. The 10-year Treasury yield down just over 2 basis points. We are just shy of 150. 149.90 is where we sit. And then, of course, keep an eye on the cable rate today. We had Goldman Sachs joining other economists and saying that the BOE is not going to hike next week, pushing that expectation out until February as we see these new restrictions coming into place in the UK. So the pound is hovering right around its lowest levels of the year, right now trading at 131.98 against the US dollar. Now, of course, while we're talking about the Omicron variant, we're really talking about how much vaccines are able to fight it. That has been a major question hanging over this market for 2 weeks and hanging over the shares of vaccine makers as well. There's just not a lot of clarity at this point as to how effective these vaccines are against this variant. You are, though, seeing a little bit of a bid coming into vaccine makers as they fluctuated over the last several days. Pfizer up 0.6%, BioNTech, its partner, up 2.4%, Moderna getting a little bit of a lift as well, and then Novavax, which of course is still awaiting EU approval for its candidate, is up about 5% at this point in the early hour session, Matt.
All right, listen. There is some legitimately scary data coming out of Europe right now in terms of the COVID disease and the new Omicron variant. For our listeners on Bloomberg Radio, I will tell you, I've got a chart next to me that shows the daily new COVID cases, a 7-day moving average for Europe in blue, appropriately, and for the rest of the world in white. What we're seeing is Europe coming up above the rest of the world. Right now in Europe, we're looking at a 7-day moving average of 399 new cases for every 100,000 people. It's near the highest it's ever been, if not already at a record. In terms of the rest of the world, it's still 213 new cases over the last 7 days per 100,000 people. And at least anecdotally, I'm seeing this affect travel. Danny, I know you have advised your parents against going to New York for Christmas. I have just canceled a business trip to London because not only do I not want to get the disease, I don't feel like doing the admin. I would have to fill out like a 50-page form to get to London. I would have to test before. I would have to book a 70 quid test while I'm there, whether I use it or not. And I have to wear a mask everywhere. I don't want to do that. So I'm not going to spend the money to buy the ticket. I'm not going to spend the money to reserve the hotel. And I'm just going to stay home. I wonder if a lot of other people are thinking about this and how that's going to affect the economy. Luca Paolini, Pictet Asset Management Chief Strategist, joins us now. Luca, do you see a significant slowing in economic growth due to this new variant?
No, I don't think that. I think, first of all, we don't know a lot about the new variant, so it's difficult to make a call here. I think the anecdotal evidence, though, seems to suggest that consumers seems to remain quite optimistic. And it's too early to tell. Yes, people will not go to work on a daily basis, but I think they will continue to spend maybe more on goods, less on services. We have seen this before, and what we have learned is that the markets continue to be quite strong as long as there is the prospect of a reopening of the economy. It will take probably 2 months, 3 months, more than expected. But as long as we see that, potentially, at the end of the road, I think the economy and the market will continue to be relatively strong. So that's our base case scenario.
Okay, so continued strength for the markets and the economy. Does that mean that central banks and monetary policy can proceed ahead as scheduled, pay the variant no mind?
I think that we'll see an acceleration of the pace of tightening, not just now. I think it's fair that central banks will probably want to wait a few weeks, maybe a month more, but this doesn't change the direction of the market. It is strong earnings. Yes, there will be tightening of monetary policy, especially in the U.S. I don't think this variant may delay the decision by a few weeks, but it's not going to completely derail the plan of central banks to tighten monetary policy.
And as we look out into 2022 in a world where we are likely to see tightening of policy, what does that mean for risk appetite?
I think what is important, I think we tend to overestimate the importance of central banks. First of all, a lot of rate hikes are already priced in. So what really matters here is the surprise element. Are central banks going to hike more than expected? Probably not. there is a risk, but I think what is important, that's what we have learned in previous business cycles. As long as the US economy and the global economy is recovering, as long as the labor market is strong, I think the direction of travel continues to be higher. And I think, of course, there will be more volatility, there will be corrections, but the bull market is intact as long as jobs are created and companies generate enough profits.
Luca, you may think the direction of travel will be higher, but there is a lot of disagreement whether or not that holds true. Bloomberg's survey on year-end estimates for 2022 has Strategist the most divided, the second most divided in a decade. What needs to be known to be more confident about the direction of this equity market?
Well, let me say that relative to a year ago, I think it's fair to say the sentiment is less optimistic. A year ago, we just had the US election, the vaccine news. Now I think there is less optimism. And for us, that's a good sign, because I think what is dangerous in a bull market like this is that when there is too much optimism. I think you're completely right. There is a lot of uncertainty. When you look even at earnings forecasts, we are talking about 7-8%. There is not much upside according to consensus. But if you have growth in the US of close to 4 or 5%, for example, it's difficult not to see another significant improvement in earnings. And this should be the key driver for markets next year. It's all about profits. It's all about the economy. And I think we are overestimating the impact that central banks can have even in this market.
Luca, you and the team over at Pictet, though, are also underweight high-yield bonds, or bonds in general. How do you then get to that call?
Well, I think when you look at credit, this should be one of the best times to buy credit, right? You have a very, very supportive monetary policy. You have a strong recovery in growth. The problem is valuation. We have high-yield bonds in Europe and the US trading at spreads close to 300 basis points. For investment grade is 100 basis points. I think it's difficult to see the upside, even in the event of a positive surprise the U.S. economy. I think it's fair to say that credit is, for us, one of the most vulnerable asset classes. It's expensive. There has been a huge amount of supply in the past few years. I really don't see much upside from that asset class.
Yeah, is valuation the biggest problem when you look across asset classes? I mean, we had a note from Ven Rom on the MLive blog today talking about the possibility of a Minsky moment, and the concern isn't so much economic growth, but just high valuations. Everything's priced to perfection, and then some.
Well, I mean, I think we have to differentiate here. We still have markets like Brazil, for example, trading at 7 times forward earnings. When you look at Europe, we are talking about multiples, for example, in the UK, 12, 13 times. I think there is an overvaluation problem in some parts of the US market. But when you look at globally, again, a 12 months PE of 18 times earnings for the global market, considering where bond yields are, yeah, it's not cheap, but I think the overvaluation is really in some parts of the market, mainly the growth part of the market, mainly US. I don't think there is a huge overvaluation problem on the equity side, but for sure, valuation is not supportive. The upside is on macro, it's on earnings, not on valuation.
Yeah, plenty of folks this week willing to step in and buy the dip in some of those expensive tech names. Luca, really great to have you on with us this morning. Thanks for your time. That's Luca Paolini of Pictet Asset Management. Now, coming up, nuclear fusion, once seen as science fiction, may be inching closer to reality. We've got the latest data on clean energy tech that's backed by billionaires. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an exclusive interview with Alex Gorsky, Johnson & Johnson Chairman and CEO. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Danny Berger in London and Kailey Leinz in New York. Now, a world of cheap and clean energy may come sooner than many people think. The nuclear fusion industry is attracting some serious investors like billionaires Bill Gates, Jeff Bezos, and Peter Thiel. And according to Bloomberg Intelligence, the industry could achieve a $40 trillion valuation. Mike Dennis's research note on this was one of the most read pieces on the terminal last week, and he joins us now to talk about a world where we don't have to pay much for energy that's just as clean as solar or wind. Mike, isn't the initial outlay the biggest problem with nuclear right now? Isn't that the concern?
Well, it could be. I mean, if you look at some of the big government projects like Inter, you know, you're talking sort of $21 billion already invested. But if you're looking at the private companies like Commonwealth, you're talking about $3 to $4 billion. They're looking to build very much more small demonstration to commercial reactors in the next 5 years.
So, Mike, is this going to be primarily a private capital-driven story?
Well, not entirely. I think a lot of it is about the spin-offs. A lot of it is about the link-ups between some of the big energy companies like Chevron backing ZAP and like Eni, the Italian oil major, backing Commonwealth Fusion. So some of it is becoming more integrated with the majors, but the majority of the rapid increase in the technology is coming from the 35-odd private companies that are building fusion reactors.
Mike, it's not that nuclear power is new. It's been around for a while, or at least the idea of it. If it's safe and sustainable, why has it taken this long to get some serious backing behind it?
I think there are some hiccups along the way. I think this came out of the Manhattan Project in the 40s and 50s, obviously with nuclear fission and bombs. The fusion side of it has taken a long time to develop because the whole technology of confinement, containment and density to create plasma, which is fusion, has taken a long time to gain our understanding of the science. What's really changed is that the government backside of it, the science has been proven. Now it's the private sector that is really accelerating it. That's the interesting bit.
The concerns obviously arise. You know, older people will remember 3 Mile Island, Chernobyl. I think there was a recent documentary on that. Fukushima, even the kids remember that. How do we assure the public that we're not going to have those kind of disasters and that we're not going to be looking to store, tons and tons of Simpsons-level toxic waste in your backyard someday soon?
Well, it's a fairly basic set of ingredients. It's basically lithium that makes tritium, and it's water, and there's an abundance of that on the planet that makes deuterium. So in terms of the actual products, the sort of radioactive side of it, if that's where you're interested, is more of a half-life of like 12.5 years rather than thousands and hundreds of thousands of years with the nuclear industry. So there's very little risk of building up a huge nuclear waste, mainly because of the small quantities used in fusion and the fact that it's very short half-life for what is the end product.
Mike, really fascinating stuff. Thanks so much for joining us today. Really appreciate your time. And of course, you can read Mike's work and the rest of his team at BIGO. That's Mike Dennis, Bloomberg Intelligence Thematic Strategist. Now, coming up, Boris Johnson on the back foot, how the Prime Minister's COVID plan might impact the UK economy. This is Bloomberg.
What really I think will be the final verdict will be the real world data, when we see what happens in the real world. If people that they have the 2 doses are protected, if people that they have the 3 doses are protected or not. Those are data that we are expected to see towards the end of the year, again in enough numbers. Now we see, but it's small numbers, we can make mistakes. And all of that will come together, I think, before the end of the year.
The CEO of Pfizer there speaking with Bloomberg yesterday on the vaccine's efficacy against Omicron. Meanwhile, here in the UK, Boris Johnson is moving the fight against COVID to what he calls Plan B. That's tightening pandemic rules to curb the spread of the Omicron variant. he advised people to work from home and mandated the use of so-called vaccine passports in large venues. Johnson's plans represent a significant change in approach and is politically risky for the UK Prime Minister. Therese Raphael, Bloomberg opinion editor, joins us now. And Therese, that political riskiness comes at a time where Boris Johnson is trying to bat away accusations of Christmas parties last year when there were other restrictions. You have a fantastic piece out saying one poll showed only 9% of people believe the Prime Minister's denials. How does that translate into our willingness to listen to him?
Yeah, I mean, this could not come at a worse time for the Prime Minister. We're used to Boris Johnson sort of lurching from crisis to crisis, and generally they tend to blow over. We saw his former advisor, Dominic Cummings, break lockdown restrictions for Barnard Castle. We've recently had weeks of negative headlines over MP lobbying. This feels different, in part because it's, as you say, coinciding with the increase in infections from the Omicron variant and a return to restriction. Now, Dominic Raab, his Justice Secretary, just said, I think less than 3 days ago, we don't have to go to Plan B. We're well protected. So that's partly why we're seeing so much outrage from the backbenches. There are a lot of MPs that oppose lockdown restrictions. And at the same time, we've got these allegations that not just one, but several or more parties were being held at Downing Street. The government's official line is that there were no parties, that rules were not broken. And so these two things are clashing, and then there's a real question of government credibility.
Yeah. Well,
Wait,
a lot of people said regarding the timing. Yeah, go ahead, Matt.
Not as such.
I'm sorry. I thought yesterday Johnson came out and apologized. They haven't admitted it yet?
So they've apologized. He's apologized for the video. He's apologized, and he's appointed his cabinet secretary to investigate the allegations of a party on December 18th. Sajid Javid, his health secretary, has said that investigation could be widened to include other allegations of a party. But it just gets more and more sort of bizarre with every day, because these were events that took place really under the Prime Minister's roof, and there's very little clarity what happened. But the video catapulted this onto a national stage in a way that just newspaper reports couldn't.
I'm sorry. It just seems like the UK, it's not just Johnson that lurches from crisis to crisis, but Great Britain, ever since Brexit, Theresa May had her share of problems as well. Is there any sense that this volatility is going to smooth out next year?
Yeah, I mean, if you were to look at the polls now, with some of them showing that over half of those surveyed think Boris Johnson should resign, you'd have to say that things are going to only get more volatile in a way, because you also have lots of commitments on leveling up the economy, spending commitments that will need to be paid for. So, I think for Johnson, a real key to his longevity is whether he can deliver on his promises on leveling up, because he received huge credit from his party for Brexit, but Brexit's now in the past, and there's a real danger that his party will look to the next leader if they feel that he's only capable of kind of landing the party into these scandals. And again, a lot depends on how things develop with the virus. I think people were prepared for the vaccines and the new treatments to be a sufficient defense against the Omicron virus, but the National Health Service is really stretched right now, and that's part of what's compelled the government to move to Plan B to increase restrictions.
Well, there's also been reporting, FT, for example, reporting a government official saying, okay, this is a dead cat strategy. The idea being you present something worse, distract from the Christmas parties, and the worst thing being these restrictions. Do you buy that at all?
Well, I don't think Johnson can win either way, because the counter argument, as he said in the press conference, is, well, what if we'd done nothing and the hospitalizations had surged and people would have said, you were afraid to bring in restrictions because you worried that the scandal would ruin the credibility. So it's really a lose-lose for him on that, and one can argue it either way. But what's clear is that, those that oppose the lockdown are attacking him for having a double standard. Those who support, and it's not quite a lockdown, it's an increase of restrictions. Right. Those who support it will say that he's just lost the credibility. And of course, some of these rules are quite confusing. He said very clearly, don't cancel the Christmas parties, don't cancel the nativity scenes, but don't really go to the office. Right. And so, it's once again difficult for a lot of people to interpret these.
Yeah, absolutely. Therese, thanks very much. for your help in that. Therese Raphael of Bloomberg Opinion writing about the constantly evolving situation and constantly confusing situation in the UK. Let's take a look at what else we're watching. I'm watching the return to work, so not unrelated, but on Wall Street. Jefferies has said it doesn't want employees coming into the office at least until the end of the month, and it'll be interesting to see if more follow suit. Rich Handler, the CEO at Jefferies, said that just recently another 10 people have gone COVID positive, and that means 50 people had to quarantine. If you start to see these kind of numbers compared to, relative to their sizes happen at other banks, you could see similar messages.
Yeah, and of course, Lyft also saying not until 2023. You can stay at home until then. I'd probably go crazy if I have to stay home that long. Matt, I'm also watching Evergrande. As Bloomberg puts it, it's the beginning of the end, defaulting for the first time. It'll be interesting to see how, just finally now, will be interesting to see how the government and the PBOC, finally, the beginning of the end. Well, more Bloomberg surveillance is ahead as it's the end for us here. We're going to hear from Abbott's Capital CEO. This is Bloomberg.